Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Australian share market has had its worst start to a year since COVID, with the benchmark index off nearly 4% across the March quarter. Not since 2020 has the share market had as bad a quarter, which means many of our superannuation accounts won't look so good when we check the latest statement. How do you weather the volatility as a super investor? The information in this episode is general in nature and doesn't take into account your own circumstances. You should always do your own research and seek professional advice before making investment decisions. Annika Bradley is an investment specialist at UniSuper. Annika, welcome to Fear and Greed.
Thanks, Sean. Really appreciate you having me.
So it hasn't been a great start to the year in terms of equities, at least, in both here and Wall Street.
No, it hasn't. We have seen quite a lot of market volatility. In fact, from about mid-February through to mid-March, we saw markets sell off around 10%, so into that technical correction territory. They have retraced a little bit since then, but certainly volatility is an ongoing theme.
What should investors do? Don't panic, number one. But after they've stopped panicking, what should they do?
Well, we've seen in the last couple of weeks switching activity pick up. So we are seeing some members moving from those higher growth options into lower growth options in response to the market volatility. So I would say there are 4 tips that come to mind in terms of what to do during volatile markets. And the first is really know your why. So Simon Sinek's start with the why. Know why you're invested as a superannuant. And obviously great retirement outcomes are what we want for all Australians in retirement. So keeping that in perspective, I think, helps you stay the course and, as you say, not to panic during these periods of market volatility. Mm-hmm. The second thing is know your time frame. So great retirement outcomes are not built over days, they're built over decades. And keeping that really long-term investment time horizon in mind, I think, is particularly helpful during these periods. It sounds nerdy, and for all the lawyers listening in, past performance is definitely not an indicator of future performance. Yep. But I think just revisiting history and having a look at some of those really long-term charts to give you the perspective of what markets have done over long periods of time can be really helpful to just reorientate your expectations as markets are moving around so much. The third is know the costs of switching behaviour. So we've done some hypothetical examples just to help our members understand, how much it could potentially cost you. And the fourth is don't look. That sounds so silly, but if you are prone to switching, and in this case, past behaviour is a reasonable indicator according to the research on future behaviour. So past switching behaviour does make you a little more susceptible to switching at the moment. Simply don't log in and don't look at your super account balance. The industry talks about engagement, but I think engagement is really knowing how to grow your super by understanding your investment strategy, staying the course, seeking professional advice when you need it, not necessarily logging in every day to see what's happening in markets.
So the investment strategy, and you said there has been switching from more aggressive growth options, presumably, to less aggressive growth options or balanced options. Annika, how should people, I wonder if you have a long-term strategy and you're a 35-year-old versus a 55-year-old versus a 60-year-old, all that's going to be different, isn't it?
Yeah, absolutely. And in terms of setting your investment strategy, I'd say that is one thing to spend a lot of time on and really get that right. And as you say, if you are 35 and you've got a 40, 50-year time horizon, that is different to someone who is 65 and has a still potentially 30-year, 20-year, 30-year time horizon. But it is really important to get that time horizon right.
Okay, so let's talk about a diversification in the portfolio. So when we hear that Wall Street's gone down 7 or 8%, the local market's down 4% over the last quarter, mostly you have a diversified portfolio. So you're not just in equities, there can be offsets in other asset classes.
Yeah, absolutely. And I think when you are thinking about setting that investment strategy, there are many great diversified options available to you. And I think for many Australians, those diversified options are a great choice. As you say, they've got different asset classes within those options that can help smooth those market ups and downs a little bit. And also we think of them as a great risk management strategy. So if you are trying to avoid significant permanent capital losses and picking a stock that potentially goes bankrupt. I'm thinking potentially Godfrey's. If that's 100% of your superannuation and that does file for bankruptcy, suddenly you're in a position where you're wiped out. Whereas many of those diversified options hold hundreds of securities that possibly the biggest weight is 3 or 4%. And if one of those stocks files for bankruptcy, then you've really protected the majority of your portfolio. Not a great outcome still, but we think diversification's a very important risk management strategy.
Stay with me, Annika. We'll be back in a minute. My guest this morning is Annika Bradley from UniSuper. So, financial advice. How important is it at times like this?
I think financial advice is really important. And there are many ways you can get financial advice, whether that be a phone call to your super fund or more comprehensive advice sitting down with an advisor. During these periods, it's often just comforting to pick up the phone and, make sure that you're on track, or check in with some of the resources online, as I said, to remind yourself of how markets do over the long term. So I think financial advice is a really important part of growing your super over time.
And you can call your super fund for that. I never think of my super fund as an advisor, and I appreciate it's probably general advice, not specific advice, but you can do that?
Yes, yep. There are our member centre waiting to take your call, Sean.
Right. Okay. What about when you're coming, if you've been through the accumulation stage and you're retiring, maybe you're at the decumulation stage at the beginning of that process anyway. Is the advice any different in terms of sort of seeing through volatile times?
So as I said earlier, I think as your time horizon changes and your circumstances change, and everyone is different, certainly your investment strategy does evolve as you age. So as you're moving from accumulation into that decumulation phase, that's a really good opportunity to check in on your investment strategy and make sure it's appropriate as you begin to draw down on your super.
And this isn't specific advice. We sort of hasten to add that to listeners. But what are you talking about? Does that mean going more into fixed income cash and potentially not being as heavy into equities, that type of thing?
Yeah, so potentially, as you say, dialing down your risk a little bit. I would emphasize that even at 65, you could still have 20, 30 years ahead of you. So you want to be careful in terms of how much risk you still need to take to be able to generate that retirement that you'd like. There are other considerations as you're hitting retirement. Some people decide that they want to use their superannuation or a portion of their superannuation to, say, pay off their mortgage. And at that point, if you're going to use a significant portion of your superannuation, then working out how far in advance, you want to effectively ring fence that amount of your super, anticipating that particular cash flow.
At the moment, we are all scared of tariffs and global turmoil. Whether I'm a 35-year-old or 65-year-old in our examples that we've been talking through this morning, should I be worried about tariffs, or is it just something that comes and goes?
Look, I think market volatility comes and goes, whether it's tariffs or a pandemic or the global financial crisis. This is nothing new to markets. Markets hate uncertainty. I think you and Michael stress that often on the podcast. And this is a situation where markets are just really not responding well to the current levels of uncertainty.
Annika, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Annika Bradley, investment specialist at UniSuper. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.